2023 and 2024 were dominated by higher than expected gold price movements and precious metals movements and overall. We're talking about these themes with our next guest, Gwen Preston, VP of Communications of West Red Lake Gold Mines. Some recent news may indicate that this momentum may not be yet over. We'll talk about what's next. Gwen, welcome back to the show. Welcome back. Happy New Year, 2025. 2025 is a big year for all of us, hopefully.
Oh,
But
I think it's going to be a big year.
big year for whom exactly? Well, West Red Lake Gold has important updates to give to the audience. Pre-feasibility study, we'll talk about that. But hopefully, it's also a big year for some precious metals investors out there waiting for big gains. We've already seen big gains. It's up like 20, no, gold's up about 30% in 2024, which is a tremendous move for any year for the metal. And I mean, the question is whether or not this momentum could be sustained. That's what's on people's minds. Take a look at my screen here. This is from Bloomberg. Came in just yesterday. China's central bank is buying more gold now as prices trade near the record high. China's central bank extended or expanded its gold reserves for a second month in December, signaling renewed appetite after temporarily pausing purchases last year as prices soared. Bullion held by the People's Bank of China rose to 73 million fine troy ounces in December from 72.96 million in the previous month, according to data released on Tuesday. Now, I mean, the Chinese central bank historically has been, I don't want to call it a leading indicator, but I've been told, Gwen, by people in the industry that they are price sensitive and they are, pretty knowledgeable when it comes to understanding the flows and the trends of the gold space. So your first reaction upon reading this story?
I love that you just referenced the Chinese central bank being price sensitive because that has been that is the characteristic, the dominant characteristic of the gold market, I think, up until the last 2 years. And what I mean by that is, all the years prior, when the gold price was rising, it was always because of buying not from Asian investors to lump them together, but it was not from Asian investors because Asian investors have classically been very price sensitive. They love gold, but they buy it. They're smart buyers. They buy it when the price is down and then they hold for longer. And the flip to that has been Western investors who have traditionally bought gold when the price is rising because they're pushed there as a hedge. There's uncertainty, there's risk, there's some reason that makes them want to diversify other things that they have, and so they pile into gold en masse in preparation for an event that's coming. So they're not able to be price sensitive, they're more event or news sensitive. That's the way gold has always operated. But starting a few years ago, that sort of changed. The Western investor side of things, Western investors just ended up have for many years now just been buying the S&P and doing just fine, or buying AI or whatever it is that they're chasing. But there certainly hasn't been specific pushes for them to diversify into gold. So they've just kind of been ignoring gold. That's not unusual for them. What is unusual, I think, is how many Asian buyers have been buying gold as the price has been rising. And the Chinese central bank is lead amongst those. I mean, I think that buying from the Chinese central bank over the last 2 years is what has changed the gold price. And that, of course, touches on everything. Like, why is the Chinese central bank doing it? We don't need to have this conversation here. We know why the Chinese central bank is doing it. It's because they're diversifying the way that they are holding their wealth in anticipation, or as the world deglobalizes, de-dollarizes, shifts dramatically in all these geopolitical ways. And so that price sensitivity disappearance is really dominant. I think it is the most important factor in the gold price, and I think it's going to continue in 2025. But I think that Western investors are increasingly aware of the same kinds of risks. I don't think they care that much about deglobalization, but I do think that Western investors care about sort of the debt train leaving the station, to use that sort of analogy. Doesn't matter who's in power in America, which administration it is. There's very little that can be done to cut spending. And so the money printing continues. That conversation, I feel like, just keeps coming more and more to the fore. More and more investors are sort of, what is the risk in that? How should I manage the risk in that? And so I think that there is some Western investor interest also turning to gold, or the expectation that that will happen over 2025. So I think that they're piling on top, and yeah.
You've done some research on Chinese buying of gold. You've presented on this issue quite a few times. This is the price of gold. I've heard several narratives around the Chinese buying story. Which is more significant, do you think? The central bank aspect of buying gold, or just people in China buying gold as an investment or as jewelry or whatever the case may be?
I don't think the jewelry factor is dramatic, but I think the other two,
Mhm.
individuals buying as investment and the Chinese central bank, I do think that they go hand in hand. And I think we've seen that in news stories, and we saw that in the price of gold, the chart that you're showing right now. The price of gold based on classic historic understandings shouldn't have done what it did, because this is when rates were rising and very high in the West. And that is precisely the environment when Western investors do not buy gold, and the gold price is supposed to go down, and it didn't. It
Yeah.
did the opposite. It stayed very strong and then rose. And that's because it was buying outside of the West. And I think, for the Chinese central bank to lead and investors in China to follow is part of it. Also, the other way around. I mean, I think they really go hand in hand. They're being driven by the same rationales.
I'm going to add a few series here just to look at. We're going to add the S&P 500 first. This is over the last 12 months. Gold has outperformed the S&P 500 over the last 12 months, so since the beginning of January 2024. Gold's up 30%, like I said in the beginning, and S&P is up about 26%. Um, if if somebody who doesn't know anything about precious metals looks at this chart, just over the last 1 year, he or she may conclude that gold is a risk-on asset, and it is, and we should be buying it if we're bullish on stocks. So
Yes.
that's what that chart shows. What, yes or no for 2025 as well.
Yeah, well, I love that. Correlation is not causation. But I see that question requires me to have a crystal ball about, stocks in 2025.
Well, let's not talk about the future then. Let's just talk about this chart that I have on the screen here. The assessment that gold has behaved like a risk-on asset over not just last year. I mean, if you just scroll back, it keeps going,
yeah,
right?
for
So
sure.
ever since basically 2023, the narrative that gold is a risk-off safe haven asset, is that dead? Is that narrative, passe?
I actually don't think so. I think it is still precisely that. It's just that Western investors have no need, are not in that environment. They are not, they're in a risk-off environment. So they're buying the S&P. But other parts of the world are much more acutely aware of how shifting everything is creating risk, and they are being more proactive in positioning for that risk. So I think the gold price is showing a risk on environment in outside of the Western world, while the
Yeah.
S&P is showing a risk off environment within.
And it's just extraordinary because if you go back to 2022, where we had the big, sell off in stocks and cryptos, gold went down with it. 2022 was a bad year for all asset classes, stocks, precious metals, bonds as well. And
Yeah.
again, the narrative that gold trades counter to risk on, that hasn't really been the case since basically the last significant divergence was 2021. If you look at this
Mhm.
chart.
Yeah,
So the
yeah.
last 3 years, tell us what happened in the last 2.5 years here that propelled gold to have a closer correlation with the S&P.
Your very first question. You answered it in your very first question. In my estimation, they became correlated when the Chinese central bank decided to start buying gold again. They
Ah,
didn't announce it in March 2022, but that's when they started doing it.
mm.
And it took us a while to all realize that that's what was happening. But that is exactly when the Chinese central bank really started leaning back into the gold market.
Okay. Now, going forward, then, what is the narrative for gold? If somebody were to ask you, Gwen, I missed the boat. I missed the run up in 2024 and 2023, and $2,600 is the price today. Is there still a narrative to hold gold in 2025?
I think so. I think there is. And I think it's because of that increasing. I think it's because the chart still looks good. by which I mean the forces that have propelled it thus far are continuing. You showed that the Chinese central bank just started buying again this month. And so, I think that those forces are still acting. I think that it's a huge shift for the Chinese central bank to diversify itself away from its US dollar holdings and into gold. That doesn't happen. That takes a long time. Use the analogy of a freighter turning around in the ocean. This is like the entire ocean trying to turn around, right? Massive time frame to do that shift. And I mean, so I think that those forces that have propelled gold higher remain in play. So I think they are consistent. But I think that on the Western investor side of things, that awareness of, risk, of debt risk, of dollar risk, of geopolitical risk, I think it's rising. And I think that it's rising to a point that we're getting interest from institutions and whatnot. We're getting inbounds from institutions that are looking to position in gold because of that. They're not looking to position half their portfolio. They just want to get that hedge. They just want to get that position in. And the gold market, as I'm sure you've had this conversation many times, the gold market's so tiny, it doesn't take a lot of interest for that to matter.
One of the bear risks I've read is that we could get fewer rate cuts from the Federal Reserve next year as inflation it remains stubborn. Now, the risk here for the gold market is that if interest rates stay high, that is a headwind for the metal because there is, it's a competition between treasuries and gold. If interest rates are high, just go to money market funds. That's the rationale. So, yeah, how would you evaluate that kind of headwind here?
Yeah, I mean, I think that certainly impacts the Western investor side of the argument that we've just been discussing here.
Yeah,
I don't think it has any impact at all on the Chinese central bank
you're
or on
right.
all the Asian, Saudi Arabian, like Middle Eastern money that is going into gold. I think it has zero impact on that. It does impact the Western investor side of things, but they haven't been driving the gold price anyways.
Okay. Well, what are the gold mining companies and juniors and seniors? We'll do a broad overview first, and then we'll get specifically into what you're doing at West Valley Gold. But the gold mining sector overall, any changes you expect to see in terms of operations and or priorities in 2025? Now that 2024 was a great year, presumably easier to raise capital now that gold is so much higher. But any changes to the industry you're expecting?
I mean, I do expect to see more on the M&A front for sure. And I mean, we saw that to some extent for sure in 2024, but the action that we really saw was majors shedding non-core assets, which is a great opportunity for sort of mid-tiers to grow, but it's not the most it doesn't really add a lot of spice for investors. It's good, it's dramatic, it's important. But I think now that we're in an environment where the majors and the mid tiers in particular have had very strong cash flows for a good solid chunk of time, and they've got strong balance sheets, I think we're going to see some interesting acquisitions. And why that matters to gold equity investors is that the gold price has been really strong, but we haven't seen the love so much on the junior equity space. But if you start to see majors and mid-tiers starting to buy, development projects or, new mines or, move down the food chain, so to speak, that's what makes investors get interested in owning the smaller fish because of the potential, because of the reality that they're starting to get bought. So that's something that I do expect to see in 2025.
And I'm guessing that there was probably a reason for why there wasn't a lot of M&A last year when the gold price was rising. The seniors I know have been making very good free cash flow. Presumably their cash balance has increased for most of them. Why the hesitancy or the reluctance rather to buy projects?
Yeah, I think it's just a process. If you look at if you look through the majors, most of them sit in one of three baskets. Either they have spent the year actively divesting their non-core assets, and they likely wanted to accomplish that task, like Newmont divested 5 non-core assets last year. They probably wanted to run that process, focus on running that process before moving on the next thing. So either they've been doing that, or or they've had some major operations that they're building or expanding, so they've been focused on that side of things, or maybe they've had struggles So they haven't been able to focus because of an asset that's in trouble or some situation like that. Or they had a significant debt balance and they've been using the last year or two of really strong cash flows to address that before they make the next move. The conservatism that got built in to major mining company executives from the last bear market, you can't understate that, or you can't overstate that. Like, they are an incredibly conservative group of executives at this point because the previous group of executives wasted so much money doing bad acquisitions in the last bull market, like
So
really, and they got written down. So like
it
it
sounds like
spread.
you're just so they have PTSD from 10 years
They
ago.
absolutely have PTSD, 100%. And so I think that it's taking much
Mm.
bigger than previous cash balances to give them the confidence to make a move.
Okay, what are some of the major mistakes that they've made when it came to acquiring companies in 2020, 2011 that executives can learn from now? You know, what red signs on people's balance sheets did they ignore? What kind of red flags rather, in the deposits, in geological surveys were ignored, right? What can we learn from 2011 is basically my question.
Yeah, for sure. So I think in 2011, the mantra was production growth for the sake of production growth. It was not cash flow for the sake of cash flow, free cash flow. So they weren't looking to make money, they were looking to make gold.
Mm.
And that drove decisions. So that meant that they bought assets, as in particular, where perhaps the operating costs were expected to be fine, but the capital to get there, they required these, Galore Creek, like this big ice, huge but very isolated project in British Columbia is a really good example. I mean, billions of dollars went into that, and they didn't even manage to finish the road to get to it because that was the kind of, they were like, this is an amazing market. This asset is going to be big and we want big, and this amazing market will pay for this huge capital cost to get there. There were a lot of mistakes like that. So growth for the sake of production growth. And then there's also just this lemmings on a cliff thing where everybody's buying, so everybody wants to buy. And so then price becomes the context for deal pricing just keeps rising. And then everybody keeps using the rationale of the context of deal pricing to rationalize their next deal. And it stops making sense at a point. I think that was also, but that also just comes back to
So people
they weren't
overpaid for
doing,
projects.
yeah, they overpaid. They weren't doing deals based on making money.
Mm.
Which it sounds silly. It's like crazy, but that's actually the rationale got detached from making money. It became get bigger.
Do you think that perhaps, I'm just speculating here, but perhaps the appetite for the types of projects or deposits to acquire has changed over the last 14 years? And perhaps there's a disconnect between what the seniors want and what the juniors have currently in terms of where they're operating or the type of grade they have or, the type of ore that they have. Maybe there's just a disconnect. I don't know.
Yeah, I mean, it's a really interesting question. Increasingly, like I just talked about Newmont divesting 5 or 6 projects in 2024 because they want to focus on their tier one assets. And their tier one assets are very large mines, like 750,000 ounces a year type mines, right? That's what they want. The thing is, it's really hard to find an asset these days that can do that. And so is there a disconnect? Yeah. Is it anybody's fault? No, it is the reality of having searched for gold, copper, silver, lead, zinc, whatever deposits for all of these years. And so, the ones that are huge and reasonable to mine have been found. So I don't know how that disconnect plays out. What I do know is that the majors are very focused on making money. And so they're really focused on having rationale for each operation. So is it because they have several operations in an area that creates a lot of synergy and therefore has cost savings? Is it an upside case at a smaller asset? What is it? There has to be a rationale that makes it fit with their focus on tier one or just like more or fewer larger operations rather than more smaller operations.
Right. And is it okay? So just correct me if I'm wrong, but is it true that having one large asset is cheaper to operate than having several smaller assets accumulate to the same amount of reserves as a larger
Yeah,
asset.
yeah, for sure it is, for
Okay.
sure. Because there's just set costs at each asset that, yeah,
Okay.
absolutely it is.
Okay, so I guess that makes sense. But West Red Lake is transitioning into a producing company. That has always been your goal, and you're getting closer to that. So it's interesting because even from a valuations perspective, it's like now are we looking at this company as a deposit only, or as a discovery company, or are we looking at this as, are we starting to map out a free cash flow for production here? How do we value this company?
Yes.
How does an analyst approach your company is my question at this particular
Well,
juncture.
yeah. So analysts are literally today redoing exactly that approach because just yesterday we put out our pre-feasibility study. So now there is a mine plan with all of the costs and all of the tonnages and grades for this initial life of mine. And I say initial because, we only had 16 months underground at the project. We defined the amount of reserve of the 1.7 million ounces of resource at our project. 1.1 million of those remain outside of the reserve that we defined yesterday. But that's just a function of how much time we've had on the ground and how much drilling we've been able to do. But the part that we did pull into reserve creates a very nice mine plan. And so analysts are now able to create a full discounted cash flow model for the Madsen mine. And I mean, right here, there's a piece of paper beside me right here with all the analysts who I'm now conversing with, because a bunch of analysts need to have that model
Yeah.
in place before they're able to start following a stock. So we are specifically at that transition right now. And I mean, we plan to be putting material through our mill and producing first gold in the middle of this year. And that is not very long from now. I mean, I was in the grand scheme of mining, 5 months is just about nothing, right? Projects take 10 years. So 5 months is a very short period of time.
Pre-feasibility, tell us about your findings there.
Yeah, for sure. So the pre-feasibility study is the mine plan for the Madsen mine. And
Mhm.
I'm really careful to underline that this is like the first mining opportunity at Madsen. Haven't been there for very long. This is what we could define right now. We see huge potential to make this, like very significant potential to make this mine longer lived and likely bigger than what we're capturing in this initial mine plan.
Mhm.
But nonetheless, this initial mine plan makes a lot of sense. So it has a 7.2-year mine life. Of the 6 years of full production within that, it produces almost 70,000 ounces of gold a year, and it produces, these numbers just happen to line up, it produces $70 million of free cash flow annually on average over those 6 years. So that's an operation that makes sense, and it underlines the entire rationale. That's why we bought Madsen, because we knew it had a solid resource. It had lots of established infrastructure, so we could get it into production quickly. And we could see that there was a way that this would make a lot of money if we could just get it quickly into production in this gold price environment. And I say in this gold price environment, but of course the financial model uses a more conservative gold price. It uses a long-term gold price of only $2,200. And the reserve, the thing that the geologists used to define the reserves, was only at $1,680. So like
Mm.
there's the reality of today's gold price already shows that there's upside relative to this pre-feasibility study. But it makes good sense. And the IRR, the internal rate of return for this pre-feasibility study, is a very strong number. It's 255%. And why is it so strong? Well, IRR is essentially, as a lot of you will know, is how much money an asset is going to make divided by how much more it's going to cost to get that asset to cash flow. But there's hardly anything left to get this asset to cash flow. There's only $44 million. And that's really as we ramp up to sort of 75% of nameplate capacity over the next 8 months. That's what's left. So really strong returns that underlines our whole rationale. This mine makes sense to turn on now, even though on paper the mine life is short, and it makes sense because it makes money over the mine life that we've defined. It makes good money over the mine life that we've defined. And getting this thing into operation, developing down deeper, putting in another shaft, it unlocks all kinds of potential within the asset for it to become more.
when you're mapping out, obviously a DCF, we have to look at the cost as well. You've already raised money for the capex or not yet for the initial cost of setting up the mine and making it operational for production. Do
So
we have? Yeah.
we are funded for that. So we
Okay.
did a financing near the end of last year, early November, I think it was.
Hmm.
And then we just at the beginning of this year, we announced the close of a US $35 million debt facility. So that gives us the capital to cover us till the mine is making money. So we are well funded to get this mine back into operation.
If somebody or if a skeptic were to say to you, well, Gwen, West Red Lake Gold has traditionally, or up until now, has been an explorer. The company doesn't have a long history or expertise in producing company, and so I'm concerned that the all-in sustaining cost is going to be higher than your peers. How would you respond to that?
Oh, I have lots to respond to that with. And I'd say there's two angles to that. First of
Mhm.
all, this team, sure, what we've been doing to date has involved a lot of drilling, but this is a team of mine builders. Shane Williams, our president and CEO, has built 6 mines around the world. He's been
Mhm.
lead or among the lead team in building 6 mines around the world, including several like the Lamaque project in Quebec that are very similar to the Matson mine. He has built a team of mine builders. And so this group has successfully put mines into operation before. Also, on the cost side of things, actually, that's something that I bring up purposefully in these conversations. The all-in sustaining cost is $1,680. That some people think that that looks high, but I believe that when you start to see all-in sustaining costs reported, real all-in costs reported from similar underground mines of our nature over 2025, they're going to be pretty similar to that. That's just the nature of what it costs to mine gold these days. And in addition, this pre-feasibility study is based on actual costs, on realized costs. We've been underground for 16 months. We've been blasting tunnels. We've been test mining. We've been using explosives and buying steel and running trucks and buying fuel. And we know what it costs. So these are not thumbsuck costs in the PFS.
Yeah.
These are actual costs in the PFS, which I think is really important. This is not a study that was designed to look good for the market.
Hmm.
This is a study that's designed to be a realistic mine plan that we need to deliver on. The Matson mine failed under a prior operator only 2.5 years ago.
Right.
So we are acutely aware that the numbers that we put out in this study, we need to deliver on these numbers, or else people will remember the past and it won't work out well for us. So we developed a very realistic mine plan, and that's what we're going to deliver.
Just on the cost aspect here, the I remember when I first started covering this space about almost 5 years ago now. The all-in sustaining cost for a lot of the mid tiers and even some seniors, I remember at the time was like $1,200. You know, what has primarily contributed to this cost inflation over the last couple years here?
Yeah, for sure. And I mean, well, there's a big range of all-in costs, right? Because
Yeah,
large open pit mines have very
sure.
different all-in costs than narrow high-grade underground mines. I mean, I think labor inflation has been an important part of it. It's basically been inflation over the last 5 years. I mean, we've
Yeah.
gone through an incredible inflation cycle, right? So
Hmm.
it's largely just been inflation. I'd say environmental and permitting costs have also gone up quite significantly. That matters. Insurance costs, all like there isn't one particular driver. When we were in the mining super cycle and costs were going through the roof, we could point to some very particular things like the demand for mining equipment was so high that the costs there were really, outsized. Like we're increasing way more than other costs at a mine site. But right now, it's really just been inflation across the board over the last 5 years.
Going forward, once Matson becomes operational as a producing mine, do you have set targets for production every year? And will these targets vary depending on the price of gold? In other words, if gold falls below a certain price, production will slow. And if it, goes above a certain price, you'll speed things up a bit.
So I don't expect us to ever go below the numbers that are outlined in this pre-feasibility study. We used very conservative gold price in the reserve cutoff, and
Hmm.
we used a conservative gold price in the financial model. So I never expect us to go below the numbers that are in this pre-feasibility study. Will we go above the numbers in this pre-feasibility study in a strong gold environment? I mean, that is truly our goal.
Sorry,
Like
the number is 1,600, you said?
Oh, sorry, I don't mean the, yeah, so the all-in
Sustaining cost. I mean,
sustaining cost is
yeah,
is
so gold has
1680.
to be above 1600.
Gold has to be above 1680. Yeah, I
Right.
mean we wouldn't be putting a mine into production
Sure.
if we thought that gold was going to go back below
Sure.
$1,700.
Sure. Yeah. But
Yeah.
but just, worst case scenario, suppose something happens and it does. What is your plan? Do you just continue producing and just eat the loss, or because I know there's a cost involved to restarting a mine as well, right?
Oh, I mean, there's a huge cost involved in shutting down a mine and
Yeah.
then trying to restart it. So I can't really speculate on that. Because it would really depend on the circumstances that
Yeah.
were driving it down. Like look back to the COVID crash, right?
Mhm.
Gold plummeted, unusual situation. So I'm not sure.
Okay.
I can't really answer that. This mine makes good money. We have a good sensitivity table in our news release that shows that this mine makes good money, including if the gold price falls 10 and 20%.
Okay. Well, Gwen, what's the next piece of news we have to watch out for?
Absolutely. So the big piece of news that's next is going to be the bulk sample. And so the whole premise here is that we can mine tonnage and grade and deliver it to the mill as stated. If we say that this area is going to have this tonnage and grade and this area is going to have this tonnage and grade, the whole thesis of West Red Lake Gold is that we can do that. We can deliver on our stated promise. And so that's what we're testing with the bulk sample. And we're mining several areas and we're batch stockpiling those bulk samples on surface. And we're going to run those bulk samples through our mill in March. And then we're going to be able to say we expected this, this, and this, and we got this, this, and this. That's going to be a really important milestone. So that news will be in April. I think at the end of this month in January,
Yeah.
we'll put up some initial results from those bulk samples. So we will take samples from those bulk samples. We have a very rigorous system for how we take those samples, and we'll be able to put out some initial, what are called reconciliation results, near the end of this month. So I'm really looking forward to issuing those pieces of news.
Excellent. Thanks very much, Gwen. We'll put the link down below to follow West Red Lake Gold Mines there. So check it out. And we'll speak again soon. Lots of news to cover throughout the year, of course.
Thank you so much, David. Lovely to chat with you.
Lovely to chat with you as always. Thank you for watching. Don't forget to like and subscribe.